Thursday, May 24th, 2018. Monaco 64, home of alternative economics and contrarian views. I'd like to talk about the dollar today and the Fed. There's a lot of headlines about how the FOMC minutes that came out yesterday were relatively dovish, and that's why the dollar stopped going up. But I think a lot of people in the mainstream, especially, and some economists, they make comments, and if you really dig deep under the surface, it doesn't really make sense. And I'm going to tell you why at looking what the dollar has done since the Fed started raising interest rates in December of 2015. And that was the first time since January 2006 that they raised interest rates. So they were, for almost 10 years, had never raised interest rates. Before that, of course, I'll go through what the market's doing here this morning. Yesterday, of course, stock markets were under a lot of pressure early on before the US came in and ended up slightly higher. Is that manipulation? Maybe a bit. Will that keep the market from going lower, in my opinion? No. So it's 8:42 a.m. London. So where are we this morning? We got spot gold, which traded really well yesterday, I would say. I know we're below 1300, but we're at 1296 this morning, 1296.50 here, up $3. The range has been 1292.50 to 1297.70. So pretty, I think the high yesterday was just under 1299. So gold looks like it wants to, trying to knock on the door of 1300, which would be really positive. Excuse me. Silver, of course, was hit hard yesterday. They tried to take it down, but still here, 1650. So it's rebounded well. It's up 5 cents this morning. The Dow up down 30 points, 24,850. So still below that 25,000 level. S&P down 1.5 at 2,731. Nasdaq up 5, 69.58. Currencies are rebounding a little bit here. By that I mean the pound and the euro, which both had a pretty bad day yesterday. The pound is up 0.17% at 133.70. The euro is up almost 1/3% at 17.30, up 33 pips. The dollar continues lower against the yen. We're at 109.58, down 49. Yesterday we dropped to around 109.50 in the afternoon, and then it rebounded back to 110, and that's when gold came off against the dollar. Oil 71.51, so it's kind of stabilized of late. It's down 0.4%. The 10-year yield, yes, it did go down yesterday. And overnight it has traded below 3%. Right now we are at 3%. Does that mean that the bear market in bonds is over? Yields are going to go back down? Well, we've had yields going up for almost 2 years now. The low was 135 roughly in the 10-year in July of 2016. So rates have more than doubled in the US. Maybe the damage has been done already, and maybe we'll have even more damage, but I think we're going to keep going higher in the 10-year yield. A few months ago, when it broke through 263, it went up to 295 and came back down almost to 263, and then it's gone back up. As I said, things go in cycles, but it looks like the trend is for higher yields right now. So before I look at the Fed, I'll quickly go through the charts because I've seen some interesting things here, like with this gold chart. This is a weekly chart. You can see this trend, this channel, upward channel since the beginning, roughly the end of 2016, that gold's been going up. We've had higher lows and higher highs, even though the highs this year were not that much higher than the high in, let's say, September 2017, but they were higher nevertheless. And I'm not looking at the spike in July of 2016. Of course, that was higher. But as you can see here, we've held the bottom of this channel quite well. Is this like a place to sell or to buy? If I had to bet, maybe I would, if I was trading gold, not just holding it, I would probably maybe try to buy it with a quick stop, at around 1280. That's what I'd be doing. So that's an interesting chart. Also, I'll look at the gold silver ratio. Up until a couple of days ago, we're breaking down below 78. Then yesterday we had the raid on silver. That ratio went up, back up to 79 almost, and now it's back down to 78.58. So I think that ratio still looks negative, which means that silver should continue to outperform gold, and that generally is a positive sign for precious metals. What I want to talk about now is the Fed and interest rates and the dollar. So for example, we've got this article in the FT. It says dovish feel to Fed minutes keeps dollar off highs, right? It says here, and I quote, leading quote, the minutes of May's Federal Reserve monetary policy meeting confirmed that the majority of members thought another rate hike is warranted soon, firming up market expectations now at 90% of another 25 basis point move at the June meeting. Yeah, that's nothing new. But there was no hint of a faster pace of tightening in response to inflationary pressures. That's from Ian Williams, economics and strategy research analyst at Peel Hunt. Never really heard of them, but some of you might have heard of Peel Hunt. But then you go back at the dollar index, and I've written here on the chart, Fed raises interest rates from 0. So that was December 16th, 2015. And look where the dollar index was. I took the close of that day, dollar index, 98.39. 98.39. Where are we now after all the rate rises we've had since then? 93.84. So what's the dollar done since that rate rise in December 2015? Well, it's gone down. So it did go up in the interim, but overall it's come down. So, and now I want to show you the recent history of the Federal Open Market Committee rate, Fed funds move, rate hikes. It's on the left-hand column there, Fed funds rate. I'm not going to look at the discount rates. You see that going back to 2002, that was when Greenspan was really aggressive after the dot-com bubble burst, after 9/11, and rates were cut all the way to 1% in June of 2003. They kept those rates there until May 2004, so not even a year, okay? And then they started raising rates again, and they raised it all the way, to 525. The last time they raised it was June 2006. So, and then after that, of course, the crisis came about 18 months later, and they started cutting rates in 07, 08. And then Lehman collapse, September 15th, 2008. And then on October 8th, they had a unscheduled emergency meeting, and they cut the Fed funds rate from 2% to 1.5%. That was after the Lehman collapse. They met. They couldn't even wait to the scheduled meeting on October 29th. They had to meet then and cut rates from 2 to 1.5%. That was post-Lehman collapse, post-crisis. And look where we're now, 1.5%. Look where the rates were when Lehman collapsed, after Lehman collapsed, 1.5%. So we're still at emergency rates. Yes, they went lower. Eventually, they took it down to 0 on December 16th, 2008. The next crisis is going to be many times worse than what we had in 07, 08. After the dot-com bubble, yeah, they took, and 9/11, they took rates down to 1, but they kept that rate at 1 for less than a year, and they started raising it already. This time, they've kept rates at 0 they kept it for 7 years, because December 16th, 2008, they started raising it December 16th, 2015. So 7 years they kept rates at 0, not 11 months. And if you can't go back to 2006, so it took them like almost 10 years to actually raise interest rates again. So when you hear these things that the Fed's going to be hawkish, not hawkish, they're still like drunken sailors. They're still, well, they're treating the market and the banks like drunken sailors. They're still taking out the punch bowl. The party's still going. Instead of giving people, let's say, a pint of beer every 5 minutes, they give them a pint of beer every 7 minutes. Because people are still getting drunk. So I think it's all, you need to really look into it. And that's why I think it's important to go back and look back in history. So yeah, to all those people who are worried, who say, oh, you know, the higher rates are going to bring gold back down and silver, the dollar is going to be stronger, you know, but we've had 6 rate hikes. We're going to have the 7th now in June, and the dollar is still below where it was, and we are still almost at the same rate, Fed funds rate, that we were right after the Lehman crisis. So there you go. That's what I wanted to talk about. You know, the Fed, the dollar, interest rates. And if you enjoyed this video, please like, share it far and wide. Subscribe to my channel if you haven't yet. You can also follow me on DTube, Steemit, and Twitter. And I wish you a good day, and I'll talk to you later. Take care.